Yesha, you know the rules. I think Hemant, you are the discussant. Would you come to the front? Because I think that you're going to use the mic to do the talk. Oh, super. So you're all geared up. Yesha, Hemant is your discussant.
Hi, Hemant.
Hi, Yesha.
How are you?
He's just recovered from COVID.
Oh no.
But I've recovered. So
Yeah,
don't.
but he's recovered.
That's amazing. So are you feeling okay now?
He's boosted with all the antibodies, yeah.
I know. But you were vaccinated, I hope.
He's a superhuman being just now.
He is. I got COVID too, by the way, you know, right?
Yeah, but that was a long time ago. You had
I know. My antibodies have gone. I'm no longer a super person.
Yeah, there are multiple upon you. All right, Yesha.
Okay, so let's go.
We'll keep
Okay, can you
has 15 minutes. And when you come up as a discussant, Yesha will keep time check on you, and you have 10 minutes, and then we open it up to the floor.
We can't
You
cut
have
it.
no incentive to keep track on him, right?
Yesha, your voice, the volume has just vanished. We can't hear you.
Oh, why? Can you hear me?
Better, but less than before.
Oh, okay. Everything should be the same here.
Okay, now you're clear. Go for it.
I'm clear. Okay, before I lose it. So thank you so much to Susan. Thank you so much to Jyoti. Thank you so much to Shaina for putting together this amazing event. And thank you so much, Susan and everyone, for bringing us all together in this amazing conversation. I have seen a snapshot of the blood, the sweat, the tears, the hard work, the details, the emails that it has taken for all of us to be in this room at the same time across 17,000 time zones. So Susan, you are a hero to us nerds in the room. You are a Marvel superhero of market research, and we love and adore you, as we do every single year, for making all of this happen. Also, because I don't want a break with tradition, of course.
Hardly wait.
Yes, where is it? I also want to make sure that I can congratulate you for your haircut. This is an old picture, but I want to congratulate you for your post-COVID haircut, which is a fantastic new do. You are looking gorgeous and sensational as always, but extra special in the hair department. So amazing. But that is not what can be said, as we know, for this guy. So as we know, as someone who did not go to Susan's hairdresser, Elon Musk, whilst all of us have been wearing our pajamas over the lockdown and declining social invitations, Tesla and Elon Musk, as we know, right, has been riding extremely high over the last few months in the world of its market capitalization. So Tesla has, of course, reached that tremendous milestone of becoming one of the very few companies that have achieved a $1 trillion market capitalization. So in October 27, when this happened, right, when Tesla reached this sort of incredible status, right, trading volume in Tesla stock and its options simply exploded, as one would predict it happening, reaching, I think at that time, record high volumes of trading. But when we think about the impact of the status and its effect on corporate valuation, its effect on the corporate capital structure, its impact on the potential agency cost that Tesla might be facing at that time with this kind of different status that it was occupying, right? So even though equity trading volume in Tesla stock and options simply exploded, looking across at the bond market, looking across at all the publicly issued debt, bond debt that Tesla had issued, right, on this momentous day when Tesla reached this incredible milestone, Tesla's public bonds, almost all of them, traded exactly, let me check my notes, traded exactly 40 times. Right, so even though our public equity markets were exploding with trading activity in response to this news, Tesla's bond markets, right, were doing basically nothing at all. And I think all of us in this room, right, are aware of and completely conscious of the tremendously tragic place that the bond market traditionally represents, right? This is a sad and inert environment where liquidity generally goes to die. And we're all kind of aware of it. We're all kind of understanding that that is simply the way the world seems to work. And the goal of this paper is to ask why, right? Why is it that investors in the corporate bond market, as Lee just described, institutional investors for the most part, right? Expert, experienced investors in an $11.2 trillion market in the US. Why do these investors accept a state of affairs whereby the liquidity of their claim is so completely diminished? And what my co-author Jonathan Brogaard and I seek to argue here is that the reason why we are in this predicament, the reason why we've accepted such a suboptimal bond market as a fact of life, the argument that we make here is that the bond market in its very fundamental design is broken. Unlike equity issuers that can enjoy the best of all possible worlds, right? Bondholders are forced to choose between owning a claim that protects them against the agency cost of debt versus owning a claim that is liquid and tradable, that can allow them to be much more strategic about how they manage their risk and liquidity. Right, so what we argue here is that bond markets today are characterized by a reliance on contract as the main method of self-protection. And as a result, they're being asked to choose between tailoring themselves and protecting themselves against agency costs, choosing either that, protection against agency costs, or choosing a claim that is liquid and tradable. And so this tension in bond markets, we suggest, has deep implications for the ability of bondholders to act as good governors in the bond market at a cost to capital allocation and credit efficiency in the market more broadly. So that in a nutshell is the paper. I guess I have like 10 more minutes and maybe we can just talk about Susan and the gang for the next 10 minutes. Can we just do that? Celebrate you guys? Can we, Susan?
She stepped out of the room, but no, 10 minutes, you have to explain the argument and justify.
No, don't. Okay, so I would rather talk about Susan the gang, but let's talk about the paper. So, you know, as we all know, how many people in the room, let me just see, how many people in the room have done research in equity markets recently? How many people have done research in equity markets? Pretty much every single hand is up, I think, right? Pretty much every single hand is up. That's the norm, right? That's our norm, right? We are so deeply enmeshed in equity markets research, as of course is regulation and the legal system. Shareholders today are protected by a deep thicket of protections, including, of course, the fiduciary duty of loyalty that protects them against managers, right? As well as rights and entitlements to protect the value of their claims, such as appraisal rights. Institutionally, equity holders are coddled, right, by a deeply expert judicial bench in Delaware, as well as more broadly, that is expertise and experience. They are supported by lawyers, accountants, analysts, journalists, equity market structure experts, right? That are paying attention to the marketplace, as well as the integrity of their claim and their shareholder rights. No such luck, unfortunately, for bondholders, right? Let's bring out the violins here. Instead of enjoying inherent intrinsic protections under corporate law and securities regulation, bondholders enjoy a much thinner veil of safeguarding for their claim as a whole. Right, so what bondholders have to do is essentially protect themselves using their contract between themselves and the issuer. Right, so bondholders are expected to protect themselves by negotiating and crafting a contract that is tailored to protect them against the risk that is posed by the issuer, as well as the particular issue that they're investing in. As a result, we've all seen this, right? These deep, thick bondholder indenture agreements that contain all sorts of provisions, right, that are supposed to protect bondholders against the agency costs of debt, including the costs created by not just managers, but also shareholders that are incentivized to take undue risks at the expense of bondholders. So what we have in these contracts are detailed provisions usually to constrain borrowing, to constrain dividends, to control expenditure, to maintain a basic financial health plan for the company that can afford bondholders some sense of guarantee that their entitlement is, and the default risk they contracted for is as it's supposed to be for the maturity of the term. So
Yesha,
the argument,
can I interrupt you right there?
Sure.
This I'm actually really mystified by. The claims of the bondholder are senior. So if anything, you would have expected the equity guy is jittery.
But the standard corporate law account here is that, of course, equity holders are jittery to some extent, right? If they're taking on excess leverage. Nevertheless, there are agency costs of debt here that mean that shareholders have an incentive to lever up the company, knowing that in the event of bankruptcy, they will be wiped out in any event, right? So they are going to be wiped out anyway. So in the interim, let us take risks, ensure that we can extract value from bondholders, particularly given the fact that traditionally they have not, as we'll talk about later on, they've not essentially protected themselves by being activists and enforcing the covenants that they have at their disposal. So even though shareholders should be jittery because they're the residual claim holders, because they're the residual claim holders and they're going to be wiped out anyway, they have an incentive to enjoy the party while they can and levering up and taking advantage of bondholders in the process. So the argument that the paper makes is that bondholders are forced to choose today. They're forced to choose between having a very tailored contract that protects them against the agency cost of debt, right? They're forced to choose between tailoring precisely their contract, and as they do so, they lose tradability in their claim. In other words, the more tailored their contract becomes, the less tradability this claim is going to hold. Right? The claim becomes less comparable, the claim becomes less fungible with others, the claim becomes less standardized, right? The claim becomes one that is harder to analyze and pay attention to. As we heard from Craig Lewis yesterday, investors are suffering from all sorts of attention deficit problems, right? And so the need to protect oneself through the contract, to tailor this contract, means that by design, bondholders are also giving up liquidity in their claim by making this claim less standard, less fungible, more complex, and more costly to analyze and understand. And so it's unsurprising, right, that bond market, secondary bond market structure, rather than looking more like the equity markets, instead operates as a very opaque, complex, and costly dealer market. Right, where bondholders are paying extremely high execution costs, right, in order to be able to entertain the notion of trading their publicly issued claims. So what we suggest here is that this tension between tailoring a great contract to protect oneself against agency costs and tradability of that contract, that this basic tension has cost for the ability of bondholders to exercise good governance in credit markets. So whereas equity holders in public markets, they have a wonderful time with an aligned interest between the ability to exercise governance and liquidity, bondholders enjoy no such advantage. Right? Equity holders can use this alignment for the good. Right? As we know from literature in corporate governance, right? Equity holders can use the threat to sell their share into the public market as a way to create a pressure on management to behave better. Right? We've heard Admati and Fleiderer's Wall Street walk, right? Investors using the threat of exit into a very liquid and transparent and informative market as a way to push managers ex ante towards better behavior. Admati, Fleiderer, Edmonds, and other folks, right, talk about this persuasive and expressive power of bondholders as a key aspect of corporate governance in today's marketplace. Right? In addition, of course, as we know, equity prices today are super liquid, very informative, and they've as a result, evolved to become a regulatory lever for monitoring companies. Right? In the US today, equity prices are often a trigger for securities class actions. They're a trigger for the market for corporate control, incentivizing better behavior by management, incentivizing investors to pay attention because their costs of doing so are mitigated by a very efficient, informative market. For bondholders, though, this ability to exercise good governance, debt governance, is heavily constrained. Right? The tension between having a tailored contract versus a tradable contract means that there's no alignment between activism and good governance and liquidity. Bondholders face a much more difficult and costly task in using their stake to persuade management to behave better, to take on less default risk, because the threat to sell is much less persuasive. Right? Bondholders face much higher costs when it comes to selling their stake. Execution costs are high. And importantly, the market is just not that efficient. Right? Transparency is not the same as it is in the equity market. Right? And so the threat to sell and the expressive power of that sale is reduced relative to what equity holders enjoy in the publicly traded equity markets. Similarly, the deficit that we have that compounds this cost, right, is the fact that prices cannot act as a regulatory lever here. Bond prices are much less liquid. There's just not that much trading in the bond market, as we know. Pre-trade transparency is very low. Execution costs and spreads are very high, right? And so prices have not evolved to the stature of being regulatory levers that can mitigate some of the costs of monitoring and good governance. And so even though bondholders in the public markets might want to exercise governance, they cannot easily rely on prices to signal that there's trouble at a potential, that there's trouble at a firm.
Yesha,
And so-
there is a time signal I'm giving you.
Oh, time signal, how much is left? 5 minutes, 10 minutes?
One more.
Minute? 1 more minute. Amazing. I'll be super quick. So the prices are operating as a much weaker monitoring mechanism here. Finally, what Jonathan and I seek to do is tell a new story about bondholders, right? The traditional account here is that bondholders are apathetic and lazy, that they're just not good at enforcing their covenants. They're disinterested from bond market governance, right? There's a traditionally under enforcement problem in bond market contract enforcement, right? Contracts have not, indentures have not traditionally been enforced as actively as they should have been relative to the defaults that they have had in their contracts. And so the traditional account has been that bondholders are apathetic, dispersed, and lazy investors. We present a new account. We suggest that this tension between tailored governance and tradability means that bondholders are facing a deep cost irrespective of what they're doing, right? They're facing a baked-in cost. That means that their desire to exercise governance, to take costly measures to protect themselves, to be active enforcers in the market, right, is heavily priced, is expensive. And so it's unsurprising that these folks would not be as activists as maybe equity holders would be, because their costs of acting and engagement in this market are incredibly high, owing to this tension between having a good tailored claim versus having a claim that can be traded and be used to exercise a strategic ability to trade and express particular viewpoints through that trading. Finally, we'll be very quick. We suggest greater standardization in contract design in the bond market as a way to increase investor choice. So we suggest a two-part bond market. The first part, where you have a set of standardized contracts with increasing tiers of governance intensity, and investors can choose which tier they want. And we hope that this greater standardization gives investors some debt governance, whilst also emphasizing liquidity as a key part of their claim. In addition, we suggest one part of the market that remains as traditional as a status quo market, where those who wish to have a claim that is less liquid can continue to do so, but having a claim that is much more tailored, much more precise, and that can potentially be enforced by those who are more engaged in debt governance as a whole. So that is really our paper. And Hemant, we very much look forward to your comments, and the group and the team really would look forward to your insights on this idea.
Thanks, Yesha.
Okay, so thank you, Yesha. I think it was a wonderful explanation, wonderful presentation to begin with of this wonderful paper. I mean, you have this paper to begin with. I must say that what interested me was going through it, I realized I'm prouder of India because we are not very different from US actually.
Absolutely.
Right. So extensive set of references to support your hypothesis. So what I will do is, without wasting time, I will get into the paper straight away. And what I have done to begin with, I will just quickly, in a minute or so, I will represent the abstract, the core of the paper. So what John and Yesha are saying, that to begin with, the bond market, which is premised on a contract between the issuer and the investor, that is a fundamentally flawed regulatory design, and that leads to neither the benefit of investor protection nor there is a market quality. That is the central premise of the paper. There are three contributions that the article makes. First is the highlighting the conflict between, getting a creditor control, securing creditor control. The creditors don't get adequate control. But if they want, actually, currently the status is they try to get a lot of control by using tailorable contracts, as a result of which the tradability of the bond claims suffer. That is the first thing. Second, they are saying that bondholders assume transaction costs that do not exist in the equity markets for reasons of agency issues, which we'll see a bit in the later slide. Activism is more difficult because of this, because they do not have that agency power, actually, bondholders. So a bondholder is not able to stand up and say to the managers, listen, you got to do this, otherwise, the manager says, otherwise what? That's where the silence comes in. The third part is, the third part, which itself is a three-part solution, just like Yesha mentioned towards the end of her presentation, is the standardization of the contracts. Can we have standard bond contracts, right? This is an issue we keep talking about loans, but here we are talking of bonds themselves do not have a standard contract. So can we do more of that? There is a stronger role for platforms, which means actually moving. There is a role for, we'll see in the later slide, there is a big role for trustees, the indentured trustees. So can we move from them to, let's say, exchange kind of platforms, where they today have already the capability to do a better job than the trustees in certain respects. So can we move that role to them? That will help in making the markets more efficient as well as liquid. And then finally saying that all this we can do, but we can still retain the current structure for those people who want customized contracts, even at the cost of liquidity. So we can retain this part for those who want to. So this is the core of the entire paper, in short, I have described. Now what I will do, I will take everyone through a certain. So Yesha, what I will be now positing is, or rather you have posited many claims in the paper based on various studies, and I will be asking a few questions in relation to them. I am not sure I will be able to go through all of them, so which is being anyway circulated, but some of them I will try to just present it here. So for example, to begin with, you say that unlike shareholders, the bondholders do not benefit from a fiduciary duty of loyalty, which basically is fiduciary duty of loyalty is that if the shareholders, if the managers are not loyal to the shareholders, they get fired by the shareholders, basically, if things work. But bondholders cannot really fire the managers. My question is, aren't the shareholders also concerned about the managers' responsibility towards the bondholders? I mean, are the shareholders really not bothered that a bond can default or the bond is not performing or we are going towards default? Are the shareholders not bothered at all? If they are bothered, they will pull up the managers for doing those things. So there is an indirect fiduciary loyalty. That is what I am asking. So it may be worth investigating. I do not have data, of course. It may be worth investigating as to how many managers lose their jobs or bonuses for a bond default. And if they don't, then why is it so? Right? So that may be worth thinking related to this point. Second, next is, unlike for equity, law does not protect minority shareholders. Yes, minority shareholders are not protected, or minority bondholders. Minority bondholders are not protected, but even minority shareholders are not protected for that matter. I mean, the thresholds may differ, but for getting your say into the boardroom or into the management action, even the shareholders need a certain minimum amount of holding. So I do not think that necessarily is a discriminatory thing against the bondholders. That is a uniform thing. Difficulty of enforcement, yes. This is something I quite agree with. I mean, this is more like our judicial or even off-judicial process that one has to go through to get your rights, get your claims enforced. That does happen. So, so that does happen. Although, again, a minimum shareholding is required, minimum bond holding is required either way. So that is a big issue. I mean, that is a gray area. I will not dwell into it, but this is an issue we have to figure out how to solve it. Indentured trustees also, yes, this is a very big point. This is a significant point made extensively in the paper, that indentured trustees possess weak incentives to vigorously represent their bondholders. The point being that the bondholders act through the trustees, and trustees do not have enough incentives. How do I lose? I get my fee. I mean, the bondholders gain or lose at best. That's okay. I think rather than throwing out the indentured trustees and replacing them with exchanges, let us say, how about, or that point, of course, I've written later, even here, I've written later here. How about remunerating the indentured trustees better and encouraging competition, or even seeing why that incentive is not there? What is that link that is missing? I'm not saying you have to be wedded to the indentured trustees, but maybe we can get something by looking there. And second thing, of course, have the bondholders looked at the mirror and asked, like, what is it that we are doing or not doing that it's not working? This is, the first point is tailored contract versus liquidity. It's a kind of a generic point, which I would like to make a generic comment. Isn't this the case with any OTC versus exchange contract? I mean, the moment you want a tailored contract, you will lose some liquidity. So, so the bondholders have to choose, right? This also links later to the solution itself, that in a sense trying to give some choice to the bondholders, at the same time standardizing it. But this is a generic thing. This is, I will not get into detail, I'll actually move ahead, but I have some point here. Indentures are complex documents. Well, I say that that's the nature of the beast. The definition of an event of default, a basic thing relating to bond contracts, that itself, there is not a consensus till date, and for a reason. I mean, default could mean various things to various people, So there is a reason to it. And this is why standardization becomes so difficult. Investors holding informationally richer, carefully crafted contracts, right? More likely to face poor. Yeah, so those basically, the statement is those who want to be informationally richer, those who want to have more control, they will lose liquidity because the buyer will have to go through all the specific clauses. I mean, that's the standard thing. A large bondholder does feel trapped often, right? Because one reason is that even in the face of adverse news, her own action of selling would cause the price of holding to fall sharply. Having said that, this applies to all markets, especially illiquid markets, right? I mean, earlier days, even the equity markets used to suffer from this. A large institutional investor selling in a small market cap stock, it causes the prices to fall sharply. So this can happen all markets, including illiquid markets. This is, I will skip actually. This is bonds versus equity market. Here, one thing I would just like to highlight. Yeah, a good comparison brought out by Yesha in the paper on bonds, how they're different from equity market. Yes, they are different. But the fact is there is a reason for a difference. One of the key reasons, the underlying characteristics of the risk psychology of the two sets of investors could be different. The equity investor, which has been mentioned in the paper, the equity investors have an upside also, right? The bond investors have no upside. So what happens is, number one, the distribution of returns is different, expected returns. And number two, in the bond markets, most of the paper here, for a reason, we have focused on the credit risk part of it, how the bondholders are not able to enforce claims against default. But a big portion of bond trading happens for interest rate risk, and credit risk does not change on a day-to-day, week-to-week, month-to-month basis. And for trading, the information and the change in the underlying is very important for trading. If there is no change in underlying on credit risk, what trading will it happen, right? So to that extent, the lack of trading need not be necessarily because of the indentured trustee or because of complexity in the contracts. It could be because the credit risk itself underlying does not change, and investors do not want to get into it. And one of the other factors which again needs to be explored, the presence of retail investors. Unlike equity, bond investors do not have much of retail investors, can be both a cause and an effect relationship. So this is what broadly I would like to say in this slide. And then finally, you have put up the solution, which I agree. I mean, it's a good set of solutions. So a progressively thicker set of restrictions. Today, anyone goes and gets a contract signed with an issuer and say, these are the extra 5 clauses you have to add. So what John and Yesha are suggesting are that rather than having not millions, maybe hundreds of contracts, let's have 10 sets of contracts. Just 10 standard contracts, and which will be increasingly becoming more restrictive in terms of covenants as the risk increases, right? A fairly good suggestion. Having said that, in practice, this will still need agreeing to and drawing. So where are the lines from category 3 to category 4? Where are the lines do you draw? Again, someone will say, no, I want this particular clause here itself in my category 3. So yes, you can force fit saying this is what it is, right? It will have its own sets of implications, both agreement and implementation. And allowing issuers and investors to identify the risk of the issues using peers as proxy. So currently, just like I explained, you can have 10 categories. There's 10 categories roughly can correspond to the 10 credit rating categories, right? And you say have a different set of contracts, predefined contracts for these 10 categories, right? Which, I mean, a bit cynical view, if it could have been done, it would have been done by now, because we have the rating categories already, right? A set of investors would have said, or someone could have said, but if it has not been done, worth exploring, The real task would be to translate the risk categories into the specific sets of covenants, as I said earlier. And then finally, so encourage electronic platforms, which we just now talked, for example, the exchanges, the platforms. The key reason being that they are much better in collecting and disseminating information, just like they're doing in equity markets. I mean, within 15 minutes of a board meeting, the results are pushed out, that kind of a thing. So news can be pushed out. So rather than depending on trustees that you kind of monitor whether the covenants are being complied or not, can we use platforms over there? So there is a trade-off over here. For example, again, already pointed in the paper, but it's quite important point. There can be serious conflicts in the incentives of the platform as a trading platform versus a monitoring and enforcing platform and data dissemination both ways. So there could be serious conflicts that has to be looked. So yeah, I will not. And finally, the last suggestion is that continue to offer the current set of tailored indentures as well. Those who want to stick to the customized contracts, for example, there is an OTC market always exists. So they can continue in that, apart from doing these two things. So yes, so these are the solutions. So good thinking, good set of solutions for a very very difficult set of problems. Hopefully some of them can work, but I guess we will need to look at from some other angles, some other elephants in the room that we may not be seeing it. So thank you, John and Yesha, and thanks to all for listening. So open to everyone.
Thanks, Hemant. Yesha, would you like to take on some of Hemant's comments, or should we just open it up to the floor for questions? How would you like?
I would like to open it to the floor for questions. Before I do that, I just want to thank Hemant so deeply from the bottom of my heart. Your comments, Hemant, are just exceptionally thoughtful, very deep and profound, and really are just go to the heart of some of the issues that we really need to think about. So I think the way in which you have brought out your ideas, I'm really blown away, actually. So thank you so much for taking the time to read it so closely and for developing such a thoughtful analysis that really will help us to refine this proposal. Thank you so much.
Thank you, Yesha. Thank you.
Okay. Sorry, so there's an online person who wants to ask a question and I can't identify the person. So can you please ask your question and identify yourself when you do so?
Hi. Hi, this is Hansi from Money Management India.
Oh, hi.
Hi, Susan. Hi, Yesha.
Hi, how are you?
Good. How are you? So very quickly, I was actually going to suggest, I came in halfway, so sorry about that, but I came in halfway and I was wondering why standardization of contracts hasn't already been done. To Hemant's cynical view about if it could have been done, it should have been done. I don't buy that because there are practices in other markets where, for example, standardization of institutional investing is there, which is not there in India. So I kind of say maybe India is a little bit behind, but also just the role of research analysts. You don't mention their role in the equity markets.
Yeah.
So if the standard contracts were available, maybe not in the public domain, but at least to a research analyst licensee, for example, then people like me could take that research analyst license and actually analyze that bond contract a bit closer. Today, I don't have access to it. So what I'm just saying is, why don't we look at the role of research analysts in the functioning of efficient markets? And could research analysts play a role, independent research analysts play a role? Fund managers are very cynical about credit ratings. I ask any fund manager, do you trust credit ratings? And they say, no, we maintain our own research. Why do they do that? They can do it. So if they can do it, why can't independent research analysts?
Yeah. I mean, these are incredible comments. I would say that to the first question of why we haven't had movement here, I think there's a nuanced answer, which is to say we've had some movement, but not enough and not deep enough. there is a standard critique about bond markets, which is to say that they are unfortunately very path dependent. So either it's to do with the fact that the number of investors here tend to be a relatively closed club. And so movement within that club towards towards greater innovation and change within the industry takes time. And equally, it is requiring coordination, which for some reason, which I can't really explain, hasn't happened yet. Even though it's a small enough club, you would have thought that this would have incentivized movement towards change, lowered coordination costs, but for whatever reason, it's not happening. And the standard explanation is that bondholders seem to be path dependent, conservative, and hewing to the model that they've always hewed to. Now, here's the nuance. There is some change here. Electronic trading platforms are growing in the market for bond trading. About 20% now of all trading volume in bonds is electronic. And that is pushing greater standardization in the contract design to sort of back up some of the arguments that we're making in the paper, that the presence of these platforms and them trying to disrupt trading here is increasing contract innovation to make it simpler and more accessible and more amenable to trading. The other final part of this is that dealer markets, that the 24 big dealers here have a massive hold on the bond market structure. And that too could be impeding the pace of innovation. In other words, dealers have an incentive to maintain the status quo as a way of guaranteeing their own space and presence in this market. And therefore, their familiarity with contracts, their familiarity with trading, their familiarity with investments and those horizontal linkages, whatever, are potentially acting as a constraint on innovation in this market. To your question on research analysts, I think it's so important. Equity market and bond market research cannot be compared. These are two separate beasts, but credit risk is complicated and hard. And so having research analysis here to demystify, to make more transparent, to add insight, I think could be a huge transformation, could be incredibly important. I love that insight that I would love to, include as part of the reboot of the paper. So thank you so much for that.
Okay, so Shorish, because I happened to see him first, and then Devang.
Thank you. I think it's a very important paper in a sense. So I think it's an important paper in a sense that I worked in bond market for about 5 years back for a small stint, and I knew that it's broken market. I mean, most of the part of the world. One reason I think is it's broken market is because high barrier to entry. Unless you have about 500 crores in your pocket, you just can't get into that market.
Yeah. As a trading market.
Even as a trader, unless you have really big, deep pocket, you can't just go into that market. So any thought on that, that if right now, one of the reasons that it's an elite club, the bond market is an elite club because it's a high barrier to entry. Any comment on thought on that?
Yeah, I totally agree with you. Average trade sizes in bond markets is around $1 million. Compare that to equity markets is something like $200 to $300. And so, the need to have an average trade size of $1 million, of course, means that you have $1 million worth of capital invested in this market that you're willing to trade. And that's on average. So average trade sizes here are very high relative to equity. And furthermore, the cost of trading themselves is very high. The spreads here can be as high as 2 to 3% per trade. So again, those execution costs are dissuasive to folks who are potentially normal folks seeking to enter this market. That was a comment that Hemant made in his presentation. So, those two factors I think are very salient. What's interesting today is that average trade sizes are coming down. So it is 1 million today, but I think around a decade ago, it used to be 2 million. So, the average trade size in the US corporate bond market is decreasing, but nevertheless, the execution costs are not decreasing, right? And that points to the power of the dealer market that have captured execution in this market just as a matter of market design. So that I completely agree with you, Suresh, that seems to be erecting this barrier to entry that has meant that this is essentially a very exclusive institutional club. What is interesting, though, is that even though it's a very institutional club, these institutions increasingly are managing lots of retail money. So one of the big developments of this last, 5 or 6 years is the growth of bond ETFs. So bond ETFs have become huge in terms of assets under management. And that is, bringing a lot of retail capital into this otherwise very costly domain. And so it's becoming harder and harder to justify the silo between bond and equity because, ultimately the people whose capital is being used up in execution costs and illiquidity are similar kinds of people to you and I who are putting our retail funding in ETFs and bond funds and other things, PIMCO, etc. We shouldn't have to pay so much ultimately because the cost be passed on to us.
Devan?
Yeah, just a quick comment. And I'm just going back to the first principles and actually adding to what Hemant had already asked in terms of the questions. One, seems to me a fundamental part of this paper should be to really figure out why bondholders themselves are not, or what are the key drivers of a non-standardized contract, right? I mean, why are they themselves not motivated? So if the incentive of the bondholders is tradability as one of the incentives, then surely they know that having a non-standardized contract will lead to less liquidity or less tradability. So that should be definitely be a key element of the paper before you sort of get to the design stage, I guess.
Yeah, I fully agree. And it's coming to some of the other questions that were asked as well just now, which is why aren't bondholders doing more? I mean, they should do more. But, the really funny thing is that in bond market activism for us, studying it, bondholders don't seem to act unless they've been properly kicked in the teeth, right? Unless they've been really battered in the teeth, they don't stand up and act for themselves. It's very strange. So for example, there was a recent case here called Cash America in which the remedies for a breach of contract, the court decided would be very interesting, make whole remedies. The court gave bondholders that right. Bondholders are very pleased. Immediately, the lawyers for the issuers turned around and removed that provision from the contract. Bondholders did not react. For ages, it did not react. Until this magazine included a big discussion that got them riled up, that organized meetings, that organized them and coordinated. And at that point, they made a fuss. But it took a lot of effort and momentum and chance to get to that point. And I'm really stumped. Honestly, I'm really stumped. Why is it that these folks are not doing more to help themselves? I don't understand that. And there's lots and lots of theories as to why this might be the case. They're dispersed, they don't have enough stake, but clearly that's not necessarily enough to explain it, because in equity, folks are doing stuff, even though they're also dispersed, and there's a free rider problem and there's a first mover problem, and the first mover takes a thing. But still, there has to be some explanation, and we're still working to think about what that might be. But thank you so much for that.
Great. So I'm going to let Bhargavi slip in a question just like that. But
Yes.
keep it
Hi.
short, Bhargavi.
No, sorry for the last minute. Actually, it's in response to what Yesha just said right now, right? Which is that bondholders don't act. I mean, they're not really activists as such. So I was just wondering, okay, so how does this tie in with your hypothesis, which is that standardization of bond documents will actually lead to more liquidity? If bondholders don't really care about the credit protections, which is, they don't really care about at what point can they really take control or whatever, as revealed by the fact that bondholders don't really act, then will standardization add to liquidity? I mean, if they really don't care about what's in the contract as revealed by them not acting at all, then how will standardization help? So maybe you want to just, sort of reconcile the two things.
Yeah, great. I mean, I think the standardization will help because I think it means that there's potentially more trading. There's greater price efficiency. Prices might be more informative, might reduce some of the information costs of action. We're proposing in this that platforms play a greater role in coordinating and disseminating news and information, and that might reduce some of the collective action problems that bondholders are facing. So this is not to suggest that prima facie they're suddenly going to become more activist, but it's to try and say that standardization might reduce some of the costs of analyzing information, discovering default, coordinating amongst themselves, and having platforms essentially overcome some of the collective action challenges that seem to be embedded within bond markets today, and preventing action. So that's the kind of working hypothesis that we have to hopefully reconcile and get to that, your awesome kind of feeling that what difference will standardization make. I think it will potentially make this difference by lowering some of the cost of action.
So, oh gosh, now there are multiple people who are popping up, but then we do have to start the next presentation, and I don't know quite how to do it because Hemant is one of the comments. Rajeshwari, can I just take 30 seconds for, please? Oh no.
Honestly, I really miss just hanging out in that room so much.
Yeah, I know, I'm getting daggers darting at me.
How shit it is just to be here, not to be with all of you, and just, getting to be in the melee.
So what I'm going to do is I'm going to enforce timekeeping because
no, Susan, I said your hair was lovely. Doesn't that work?
Yeah, but you didn't make the effort to come here, Yesha. A big
Man, Omicron, yo.
So Sharish, Hemant, I'm going to ask you to get in touch with Yesha. Perhaps, over lunch, we'll keep this thing running. But Yesha, I'm going to call this session to a close and start the next one.
And can I just say, please, very quickly, thank you, everyone. Thank you so much, Hemant. Thank you so much to the comments I received in the room. Just exceptionally wonderful and greatly appreciated. Thank you so much.
Thanks.
Thanks, Yesha. All the best.
Bye.
Thank you. Thank you so much.